First of all, and fundamentally, we don't believe that the government would ever do anything to push property off the table as a viable investment vehicle. Okay, so they might come up with these changes every now and then, which has a small effect on mum and dad investors, but we don't think fundamentally that they'll ever do anything to royally push property or investment property off the table as a viable investment vehicle. And why? Well, really, if you're buying investment property and you're planning for your retirement, you're using it to plan for your retirement, grow your wealth, etc., you're one less person that the government has to worry about in retirement. You're sorting it out for yourself. So that's a key reason. Another reason is that if property is truly seen as a bad investment vehicle and people stop buying investment property, we will have a royally huge problem on our hands here in New Zealand in terms of providing property for the population. We already have a massive issue here with housing the masses. If you take investment property away, make it difficult for landlords to use that as an investment vehicle, it will make it really, really tough here in New Zealand, and the government sure ain't good at housing people. So I don't believe fundamentally that property would ever be pushed off the table. They might just do little things to make it a little more costly, but it should be affordable for most people, and certainly from what we've seen so far for our client base, that's the case. We have supply and demand issues here in New Zealand, so we need more properties to be built. And the government has made it clear that they need more houses to be built. So it's highly unlikely that they do anything that would slow that down. And the Labour government have already stated that new build properties will be exempt from these taxation changes. That definition of exempt, we just don't know what that means just yet. We're going to have to wait and see. But Labour's own website states, and I quote, "We're encouraging investment in new builds to increase our housing stock." They go on to say, "That's why we're incentivizing investment in new developments rather than existing housing stock. If you invest in a new build property, you will be exempt from changes to the Bright Line test and interest deductibility policy." So it's definite that new build properties will be exempt. How long that exemption will last, what that exemption will look like, we just don't know yet. We'll know sometime between now and the 1st of October. But what I wanted to do was give a property example to you. Just purely looking at this from an investment perspective, let's just use a dummy example of a $600,000 property. If we look at, and this is an existing property we're talking about now, if we look at property over the last 50 years in New Zealand, residential investment property over the last 50 years, it's done around about 10% per annum year on year capital gain in New Zealand, around about 10%. So if we had a $600,000 property, that's $60,000, 600,000, 10% of that, that's about 60 grand compounding every year while you own that property. So it's huge returns. If we try to be conservative and look at that conservatively, let's just chop it in half and say 5%. So that's halving the per annum rise over the last 50 years to say 5%. Well, that's $30,000 in a year now on a $600,000 property. And remember, that's compounding. So most of the examples we've looked at over the last few weeks of our clients, real examples, and that's admittedly in this current interest rate environment, we've seen about a $50 a week difference for them in terms of them having to top that property up $50. Now we're talking about an existing property right now, of course, because new builds will likely be exempt in that respect. Now, if that property happens to be cash flow positive, well, then it's likely that that would just net out that $50 requirement. But that's the average amount that we've seen recently from the examples we've looked at is about a $50 a week difference. But you know what? Even if it's $50, $100, $150 per week, so that's, $2.5 grand to $7,000 per year approximately. Even if it was that much, if we say took the middle ground of that top-up requirement, let's say it's $5,000 or $100 a week, say, would you invest that into something that was going to give you a return that was exponentially higher than that figure? Well, we believe yes, you would. If I told you that I had an investment vehicle that if you put in, say, $5,000 a year or $100 a week, and that would turn into $30,000, and that's conservative, remember, this is on our dummy $600,000 property, of course you would invest into that vehicle, wouldn't you? Now, we're purely looking at this as a retirement planning investment vehicle. Is that a good place for you to be putting your money? Well, yes, it is. Nothing has changed in that respect. Property for us is still the best performing investment class out there when we're talking about leveraging or borrowing to invest, which 99% of our clients are doing that. And the fundamentals as to why properties grow in value has not changed. We have to remember that. They are not changing. And that is population growth. We're still seeing an influx of people into New Zealand. A lot of those are Kiwis returning home, but that's likely to turn back to our standard influx of people from all around the world wanting to move to this gem down the bottom of the planet called New Zealand. So our population is continuing to grow. Second, we have supply and demand issues, huge supply and demand issues. It's not being resolved. There's a huge shortage of housing. So that's not going anywhere. We have a massive shortage of housing and that's not stopping. There's not enough skilled workers, thirdly, to build the properties that we need built in New Zealand. We just don't have enough skilled workers or enough builders. So that's slowing down the supply and creating even more of an issue. And of course, New Zealanders' love affair with property. That hasn't changed either, has it? So, cut a long story short, we are not concerned about these taxation changes. We are still business as usual at Good Life. And you know, we as ever recommend that our clients have a strong network of advisors around them to be advising them on their wealth creation and protection journey, and of course in particular these taxation changes. And that's people like Gareth Collard, for example, like Rupert Goff, for example, a good lawyer, good property management around you, helping you to make the right decisions. And that's the point here, everyone. We want you to be getting advice. We want you to make sure you are getting good quality advice from property specialists. And perhaps these changes won't be as impactful as you'd imagined if you get that advice. I mean, we've talked about that just briefly in this little chat here. So please feel free to check out our website, goodlifeadvice.co.nz. So it's www.goodlifeadvice.co.nz. And we really hope that we can be of some assistance.